Welcome to Charged Alpha. I'm Hudson, joined by Lana. Today's chapter, DuPont, a 200-year-old materials science company reinvented as a focused water, healthcare, and protection materials franchise.
DuPont's history begins in 1802 when Eleutherian Irénée DuPont established a gunpowder mill in Wilmington, Delaware. That heritage of materials chemistry evolved across every industrial revolution since.
The current DuPont de Nemours emerged in 2019 from the Dow-DuPont breakup. The three-way split separated commodity chemicals into Dow, agricultural sciences into Corteva, and specialty materials into this company.
In November 2025, DuPont completed another major separation, spinning off the electronics segment as Qnity Electronics. The new DuPont focuses on water filtration, healthcare materials, and industrial protection.
Today, DuPont operates two primary segments. Healthcare and Water Technologies covers medical packaging, biopharma materials, and water filtration membranes used in municipal and industrial applications.
Diversified Industrials covers DuPont's iconic protection brands, Kevlar ballistic fiber, Tyvek protective sheeting, and Nomex flame-resistant fabric, plus electrical and specialty industrial materials.
The healthcare and water side benefits from durable secular tailwinds. Reverse osmosis and ultrafiltration membranes are embedded in infrastructure replacement cycles. Medical packaging tracks healthcare demographics.
The Diversified Industrials side relies on specialty branded materials with deep customer qualifications. Kevlar in defense, Tyvek in construction and pharma, and Nomex in industrial safety, franchise products with long use cycles.
CEO Lori Koch has led DuPont since 2024. She joined from the CFO role, which she held since 2019. Her financial discipline guided the multi-year portfolio simplification, culminating in the Qnity spin-off.
DuPont pays a regular dividend yielding approximately 2%. The company has steadily increased the payout since the 2019 formation. After Qnity's separation, DuPont is a smaller but more focused capital return story.
Adjusted EBITDA margins run around 23% post-spin-off. The franchise's specialty branded products generate stable margins relative to commodity chemical peers, supported by deep customer qualification cycles.
Competitive peers include Eastman Chemical, PPG Industries, and Pentair on water technology. DuPont's advantage is depth across multiple specialty brands. Kevlar, Tyvek, and Nomex are franchise-level brand assets.
The primary risk is end-market cyclicality. Construction demand and global industrial activity affect Diversified Industrials. Healthcare and water is more defensive, but capital project timing creates lumpy revenue patterns.
The PFAS legal overhang is the other watch item. Ongoing settlements from legacy chemistries create periodic charges. DuPont manages it through a global settlement framework, but residual exposure remains long tail.
For investors, DuPont post-Qnity offers a focused defensive specialty materials franchise with attractive water and healthcare exposure, branded protection products, and a dividend without semiconductor cycle volatility.
2 centuries of materials science now refocused from gunpowder to clean water, medical packaging, and protection materials. That is the DuPont of 2026.
That is the chapter for DuPont post-Qnity. The reinvention continues. Now let's see how the new portfolio performed in its first full quarter as a focused franchise.
The numbers are ready, and the quarter is fully loaded. Let's break it all down.
DuPont crushed Q1 2026 in its first full quarter post-Qnity spin-off. Adjusted EPS of 55 cents beat consensus of 48 cents by 15%. Adjusted EPS grew 53% year over year. Revenue of $1.68 billion grew 4%. Management raised both revenue and EPS guidance and announced a $275 million accelerated share repurchase. This is Charged Alpha. Let's break it down.
For context, DuPont carries a market cap near $20 billion and trades at 20 times forward earnings. The business now operates 2 reporting segments after the November 2025 Qnity Electronics spin-off: Diversified Industrials and Healthcare and Water Technologies. The headline question Wall Street is asking: can the simpler post-spin-off portfolio sustain margin expansion?
The headline beat was substantial. Adjusted EPS of 55 cents grew 53% year over year from 36 cents in the prior year quarter. Revenue of $1.68 billion grew 4%, composed of 2% organic growth plus 2% currency translation tailwind. Both segments contributed to the beat with margin expansion.
Healthcare and Water Technologies revenue grew 6%. The segment is supported by demand in medical packaging and biopharma materials markets. Operating margin expanded approximately 110 basis points. This segment houses the Tyvek medical packaging franchise, plus the water filtration membrane business, both with structural secular tailwinds.
Diversified Industrials revenue grew 3%. The segment includes Kevlar ballistic fiber, Tyvek protective sheeting, Nomex flame-resistant fabric, plus electrical and specialty industrial materials. Operating margin also expanded approximately 110 basis points, despite mixed global industrial demand and construction trends.
Margin expansion across both segments was the key signal. DuPont demonstrated pricing power in a tariff-inflated cost environment. The fact that organic growth of just 2% translated into 53% EPS growth shows the operating leverage in the post-Qnity portfolio. Specialty branded products are working as designed.
The Qnity Electronics spin-off completed November 1st, 2025. DuPont shareholders received 1 share of Qnity for every 2 DuPont shares held. Qnity trades on NYSE under ticker Q. The separation removed the high-margin semiconductor materials business from DuPont, but also reduced earnings volatility from the cyclical chip cycle.
DuPont also announced a $275 million accelerated share repurchase. The buyback is expected to launch imminently and will retire approximately 1.5% of the share count at current prices. Combined with the dividend, capital return now sits comfortably above current free cash flow generation.
Cash flow from operations of $71 million was lighter than prior periods, reflecting working capital timing. Trailing 12-month free cash flow of $460 million provides comfortable coverage of the dividend. The accelerated buyback signals confidence that cash generation will normalize through the back half of the year.
CEO Lori Koch has led DuPont since 2024. She joined as CFO in 2019 and was promoted to chief executive after orchestrating much of the portfolio simplification, including the Qnity separation. Her financial discipline is now translating into the operational margin expansion visible in this Q1 print.
Capital allocation discipline has been a hallmark of Koch's tenure. The Qnity spin-off, the buyback announcement, and the FY guidance all demonstrate management's confidence in the post-spin-off capital deployment strategy. DuPont's balance sheet strength supports continued capital return alongside selective bolt-on acquisitions in healthcare and water technology adjacencies.
Most importantly, management raised full-year 2026 guidance meaningfully. Adjusted EPS guidance now $2.35 to $2.40 from a prior range of $2.25 to $2.30. Revenue guidance raised to $7.6 to $7.22 billion from prior $7.08 to $7.14 billion.
Valuation is reasonable post-Qnity. DuPont trades at 20 times forward earnings. Historically, the company has traded between 15 and 25 times. Price to sales of 2.85, EV to EBITDA approximately 11.5. Beta of 1.1 reflects the moderate cyclicality of the simplified post-Qnity franchise.
Dividend yield sits near 1.5%. The dividend has been steadily increased since the 2019 formation. After the spin-off, DuPont is now a smaller capital return story, but with cleaner cash generation visibility. The accelerated buyback complements the regular dividend stream meaningfully.
Wall Street's positioning has been improving. Consensus rating is buy. The breakdown is approximately 11 buys, 7 holds, and 0 sells. The average price target sits near $56, implying meaningful upside from the post-print level near $47. Several firms upgraded post-Qnity on the simpler story.
Forward EPS for 2026 is consensus near $2.38 per share, within the new guidance range. Revenue around $7.18 billion at the midpoint. The setup for 2027 implies further compounding to $2.65 EPS as margin expansion continues and the buyback retires shares.
The bull case rests on 3 pillars. First, margin expansion. 110 basis points of operating margin expansion across both segments demonstrates pricing power. The simplified post-Qnity portfolio has higher operational visibility, and the cost takeout from corporate overhead reduction is still being captured.
Second, healthcare and water tech's secular growth. 6% segment revenue growth on medical packaging, biopharma, and water filtration demand reflects multi-year tailwinds. These end markets are defensive and growing structurally. The Tyvek medical packaging franchise is uniquely positioned in pharmaceutical and biotech supply chains.
Third, capital return acceleration. The $275 million accelerated buyback plus regular dividend creates roughly 2% annual share count reduction. Combined with operational EPS growth, that drives high single-digit to low double-digit per-share earnings, compounding without requiring growth heroics from either segment.
The bear case starts with end market exposure. Diversified industrials grew only 3%. Construction, industrial, and electrical end markets remain mixed globally. If tariffs or geopolitical disruption impact construction or industrial activity in the back half, segment growth could decelerate further.
Second concern, PFAS legal overhang. Ongoing settlements from legacy chemistries continue to create periodic charges. DuPont manages it through a global settlement framework, but residual exposure remains a long-tail liability. Any escalation in PFAS litigation across new jurisdictions could weigh on the multiple.
Third, currency tailwind risk. 2 percentage points of revenue growth came from currency translation. If the U.S. dollar strengthens, that tailwind reverses. DuPont would need to rely entirely on organic growth to maintain the new top-line guidance, raising execution sensitivity for the back half of 2026.
DuPont's competitive set is the Specialty Chemicals Group. Eastman Chemical, EMN, overlaps on engineered materials and specialty plastics. PPG Industries, PPG, competes on specialty coatings and protective materials. Pentair, PNR, is the closest water technology peer. Ecolab, ECL, overlaps in water treatment services. Avery Dennison, AVY, in protective materials.
Versus Eastman, DuPont has a cleaner post-spin-off portfolio with stronger healthcare and water exposure. EMN trades at a lower multiple but with more cyclical end-market concentration. Both names benefit from specialty chemical pricing discipline. The choice depends on how investors weigh growth versus value characteristics.
Versus Pentair on water technology, DuPont offers branded membrane and filtration products at industrial scale rather than pure consumer water focus. PNR trades at a higher multiple for cleaner water-only positioning. DuPont's two-segment structure provides diversification, but also requires sum-of-parts analysis for fair valuation. The protection brands provide additional optionality.
Options activity around the print was constructive. Put-call ratio below 1 reflects continued call buying on the guidance raise, plus accelerated buyback. Implied volatility moderated post-print as the operational beat reinforced the simplified post-committee story. Options market is pricing continued upside on margin expansion.
Bottom line on DuPont. This was a clean execution quarter with multiple positive signals. 15% EPS beat, 53% EPS growth, guidance raise, and a $275 million accelerated buyback. Both segments delivered margin expansion. The post-committee portfolio is performing exactly as Lori Koch positioned it.
For long-term investors, DuPont at 20 times forward earnings carries reasonable valuation for a specialty materials franchise with margin expansion visibility. Track healthcare and water tech organic growth and diversified industrials margin trajectory as the key indicators. The accelerated buyback supports per-share earnings compounding.
Financial data and charts sourced from Financial Modeling Prep. Charged alpha is for educational purposes only and does not constitute investment advice. Always consult a qualified financial advisor before making investment decisions.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.